Good evening and a warm welcome to New Money. I'm Bryan Hirsch, and this evening we are focusing once again on the investment world. Headlines continue to proclaim that markets are reaching all-time highs. With years of experience, I know that many inexperienced investors may be tempted to jump on the bandwagon in the hope of making easy money. And joining this evening from the Zoom room in Cape Town is Henry Biddlecombe, who is CEO of AG Capital, the focused hedge fund arm of the Anchor Capital Group. Henry, good evening to you. And you know, Henry, you've been on the show many times for me, and every time you come on the show, the market's had an enormous run, and then I ask you, where do you think markets are going to go? We also know the word hedge says, hedge is defined in the dictionary as hedge your bets. So I'm saying to you, firstly, I hope you had a good holiday in Portugal. I must tell you, you can see I'm in new attire, no jersey. Don't know where spring is, but we're into summer. So, Henry, where are we in terms of what you thinking? Are we getting into, again, dangerous heights?
Yeah, Brian, it's so funny how our shows take place in between massive equity rallies. I always come across as a bear, don't I? We should maybe change the scheduling a little bit. But look, I mean, everyone who's watching the show, I'm assuming, is invested in the markets, and so they know exactly where we are. We've had a hell of a run. The S&P is sitting at just about 6,500, an all-time high. And from a valuation perspective, it's no different. If you look at the index in aggregate, it's trading at 22 times forward earnings. And even if you strip out the, which is historically high, by the way, and even if you strip out the Magnificent Seven, that index is still sitting on a forward 17, which is historically elevated. It's not the highest it's ever been. But, you know, if you go back and look at the data, your returns from this sort of level onward are not good. It's normally in the low single digit range or negative. So, you know, I'm cautious.
Henry, when you talk about being cautious, I mean, I can understand for investors, we talk about market timing is a mug's game. And if we look where the Rand is at the moment, I mean, the Rand, even I'm absolutely amazed, it broke 1750 on Friday, but that's obviously something to do with the potential of interest rates dropping in America. But, yeah, you know, one doesn't try to time the market. However, those that are in the market have to make a call, and those who are trying to get into the market may need to make a call. And I started the program by saying, you know, don't chase the market when the market is so high. But at the same time, I'm saying to many people, yeah, you've seen this before, you've sat through it. My role as a financial psychologist is to make sure that we understand your strategy, understand, are you looking for income, are you looking for growth, or you're looking for a combination of income and growth, and therefore your view of people getting into the market and people in the market. I'm interested in that.
Yeah, look, so the thing about where we stand today is there are alternatives, right? Back during COVID, for example, when the market was shooting up and interest rates were at zero, you had that anagram, TINA, there is no alternative. That's not the case today. You know, dollar cash can earn 4.5%. Rand cash can earn 10%. These are good alternatives to equity exposure at this point in time. When we talk about chasing the market, you know, it's not black or white. I mean, let's say, for example, your sort of neutral tactical allocation to equities is 70%. This is probably a good time to take that down to 50. If you've come into money or you're sitting on cash, this is not the time to buy equities, in my opinion. And with interest rates where they are, you can certainly afford to be patient.
Henry, you know, obviously with interest rates, when you talk about these highs, 10, 4.5%, one's got to realize there are tax implications on that. So when you're getting a 10% return in income and you're in a 45% tax bracket, it's coming in at 5.5%, other than the abatement you get. Under 65 is 23,800. Over 65 is 34,500. So that's what one's got to take into account. But let me then talk about our market. I mean, and let's understand, if you strip out maybe 10 or 15 stocks, both on the international side and in the South African market. Our market hasn't done that much. I mean, if you look at industrials and you look at banks and you look at maybe some of the other stocks that maybe are impressive, you look at, I think about shares like the run of shares like that people go to Mr. Price and Dis-Chem, and you look at results that came out of Aspen and things like that. So, I mean, how do you feel about our market compared to international markets? Do you think there's more value here?
Of course, yes. And that opens up a different discussion, and that is developed markets versus emerging markets. And, you know, there are two arguments, very strong arguments to be made for emerging markets at the moment, and that is the relative valuation differential between EM and DM is extreme. So emerging markets on a relative basis are looking very attractive. But also, given where we are in the interest rate cycle, I think this is the right time to be rotating into emerging markets. And you've seen a lot of strategists putting up notes over the past few weeks, making exactly that call. So, you know, if you are overweight DM, if your entire portfolio is sitting in the S&P 500, as counterintuitive as it may seem after its wonderful performance over the last 2 years, perhaps now's the time to bring a little bit back and invest in emerging markets like South Africa. You don't only have to invest in South Africa, though. You can put it into a diversified emerging markets index.
You talk about headlines, you talk about analyst reports. What about the concept about dumping dollars? I mean, we've seen now the rand improve. The rand hasn't improved much against sterling and the euro, but certainly against the dollar. Is this real, dumping of the dollars?
Yeah, I mean, look, go back to COVID and have a look at what the money supply looked like back then. You know, you've had almost an entire debasement of the US dollar over the last 5 years. I can't remember what the statistic is, but, you know, 1 out of every 3 US dollars in existence today didn't exist 5 years ago, or perhaps it's a little bit more than that. I can't recall. But, you know, and then consider the inflation that the US has been dealing with over the last couple of years, and then have a look at where rates are probably headed. It makes sense that the dollar would be weakening against every global currency, not just the rand. And the rand's been a beneficiary of that weakness.
How is that going to impact on the American economy? Because we've got tariffs on the one hand, increasing prices. We've now got a weaker dollar, so if you are importing, because they're not yet manufacturing a lot of the needs of the American people, how is that going to impact on their economy and companies' results?
Yeah, so mathematically, it's not great for the S&P 500's earnings because a massive chunk of the earnings are derived in foreign countries. So, of course, that translates into fewer absolute dollars. So it's, I suppose, short-term negative for the American stock market. However, you could argue that a weaker dollar makes for a more competitive domestic economy in the US. And, you know, that's part of Trump's long-term game plan, I guess. So perhaps the answer is short-term market negative, but long-term economy positive.
And then, Henry, let's not forget rand. I mean, the rand being at this level against the dollar. Are we still going to see more recovery in the rand against the dollar?
It's funny, you know, we always have to go back to our purchasing power parity models, the theoretical value of the rand over a 20 or 30-year period to make sense of where we stand. And you would have seen the models that Nolan puts out, pegging fair value of the rand at between 15 rand and 15 rand 50. And whenever you tell clients that, they kind of look at you with squint eyes and think that you're going a little bit crazy. But the truth is, the rand has been undervalued for a long, long time, and it continues to be, even at 17 rand 50. So is it plausible that the rand strengthens further from here? Absolutely.
Yeah. And then there's a lot of debate about interest rates. Why are interest rates so high? So let me ask you this question. In terms of inflation measures, we've had a 3 to 6% calculation done in terms of inflation. We're now talking about reducing that to 3%. So the first question is, if we even think about that, why aren't we reducing interest rates?
Well, we should be, and I think it's consensus now that the Reserve Bank's behind the cutting curve. You know, particularly given the weak state of our economy. And many arguments have been made that even an inflation target of even 3% is too aggressive. So, you know, I'm in your camp, Bryan, and you've been saying it for a long, long time. But, you know, my voice on this matter is becoming increasingly loud. I think we need to cut more.
Well, we had the situation where Trump was saying to Powell in America, cut rates. But we don't seem to see, there doesn't seem to be any powers talking to our Reserve Bank in terms of cutting those rates for the benefit of the people in South Africa.
Certainly not with the same vigor. Perhaps that's what we need. But yeah, I mean, it's, you know, if you start to see more aggressive cuts in the US, there's really nothing else left for our Reserve Bank to do but follow suit. And again, there's even room for them to cut further. So yeah, I mean, I agree with you. We're behind the curve there.
I mean, working people are struggling. You've just seen from the two-pot system in the retirement industry how much money is being withdrawn, how much tax has been paid because people are short of money. Because people that are members of pension and provident funds can put bread on the table. Because the only reason you don't work, you're not a member of either of these funds if you're not working. So you can put bread on the table, and they've needed extra money. So Henry, is there still value in our bond market, or is our bond market, do you think, taking into account lower interest rates?
No, I think there's value in our bond market, and that's before you take into account the trajectory of global interest rates. When you take that into account, I think it's actually quite a compelling equation at this point in time.
Because we've seen even when I think about it, I mean, going back 6 months, I was encouraging people to go for a 5-year government retail bond, particularly those who are not paying tax, pensioners. And I've said very simply to them, at 11.25%, it's now the 5 years 9.25%, the 2 years at 8.25%, and the 3 year is at 8.5% in government retail bonds. So you think for someone who's maybe for an elderly investor who's looking purely for income rather than paying tax, that maybe that's a good option.
It's a good option, and it's not an either-or decision. It's a good place to park for now while you wait for a better opportunity in equities. Unless, of course, you're talking about South African equity, the South African equity market. In which case you can perhaps start accumulating now.
Yeah, and Henry, lastly, before on this particular subject, there's the Satrix Divvy Fund, paying around about 4.5% with some upside growth in those stocks. Would you say that that's a good place in terms of maybe parking some money?
Yeah, I would agree with that.
Yeah. And then lastly, property funds.
Yeah,
what's your view on
reason. If you're going to see global rate compression in the next while, and I think we will, then anything that's interest-bearing or anything that's valued predominantly on its interest-bearing properties is a good investment. So that would include high dividend-paying stocks and REITs.
Well, I'm going to give you a chance to get some water into your mouth. We're going to stay tuned. We'll be right back.